Hey folks, welcome to a product review at Finominal. Today we're going to look at four of the largest long-short equity mutual funds in the US. Cumulatively, these manage more than $15 billion of assets and are from firms like EQR, Diamond Hill, Neuberger Berman, and Cromwell. The aim of these four funds is to provide lowly correlated returns to the stock market and highly attractive risk-adjusted returns. Now, each of these funds charges more than 1%, which makes them very expensive. So let's find out if they are worth their fees. We're going to kick off with simply looking at the correlations to the stock market, because as mentioned, for a long-short equity fund, the idea is that they, offer lowly correlated returns. And the portfolio construction in all four cases is very similar. This effectively is being long stocks that they believe will outperform and also short stocks, right? So to get to that long short profile. We do also have a benchmark comprised of the S&P 500 with a 50% allocation and T-bills with a 50% allocation. So very simple benchmark. Now, over here, we can see the correlation to the stock market, range from 0 to 1. And what we do see is significantly different correlations for each of those four different funds. We do see that the product from EQR, QLEIX, has the lowest correlation, 0.6, compared to 0.8, 0.9 for the products from Diamond Hill and Neuberger Berman. And that's already kind of a red flag. I mean, correlations of 0.8, 0.9 implies that there is very little diversification benefits. We can complement this correlation analysis with a factor exposure analysis. So here we have, again, 12 years of data, and we see the exposures to asset classes like the S&P 500, bonds, commodities, dollars, and also equity factors. Now, we do see that the beta to the S&P 500 in the case of Diamond Hill, like its correlation, is very high, compared to the beta of a product from AQR, where it's quite low with 0.4. We also see that three of those products, namely the product from AQR, from Diamond Hill, and also from Cromwell, have fairly significant exposures to the value factor and momentum factor, which simply means they are long stocks that are cheap and outperforming, and short stocks that are expensive and underperforming. So traditional factor investing. Also other small biases in this case, but more interesting is that the product from Neuberger Berman, NLSIX, has almost no factor exposures. So it's just equity. And that effectively, it just means, it is equity, right? Like diluted equity. There's nothing else there. And we can actually kind of confirm that via resources analysis, where we see that the product from Neuberger Berman is simply, the main resource is with 80% is the stock market, compared to almost nothing else contributes to the risk. And that means, there's no other factors that could offer diversification benefits. In contrast, for example, to the product from AQR, where the stock market only represents 30% of the resources, and you have value momentum, right, that can help with diversification. So next, let's move on to a performance comparison. We do see that one product clearly differentiated itself from a return perspective since 2013. So we have more than 10 years of data, and that is a product from EQR, which has achieved the highest total return. As mentioned, we have created this benchmark index of S&P 500 and T-bills, 50-50, super simple, but none of the other three products or funds have achieved to outperform that. Now, naturally, we can argue, right, that it's not so much about return, but more about the risk-adjusted return. So we can also look at this in one chart, right? And here we see, the risk-adjusted returns, right? We can see AQR up here with the highest return, right? Relative to volatility, on the kind of same line as the product, well, as the benchmark index versus the product from Cromwell and from Diamond Hill, higher volatility, but not higher returns. If we want to quantify that in terms of Sharpe ratios, we do see that the product from AQR has generated a Sharpe ratio of 107, which is attractive because that's significantly higher than the benchmark index with 0.7 versus the other three products, 0.18 to 0.59. That's, well, just unattractive Sharpe ratios, given that they are highly correlated to equities in general, and that you are paying high fees for that. And this kind of already concludes our short analysis of these quite large long short equity funds. Some of them, 6 billion here, 2 billion, 8 billion there, managed to do quite a bit of money. But out of 4, only 1 created value, right, in terms of Sharpe ratio and low correlations, which is from EQR. The other 3 feature correlations that are too high to the stock market, and they don't offer attractive risk-adjusted returns. So, and this is unfortunately something structural for long-short equity hedge funds, that most of them fail to create value. Hope that helps. Have a nice day.